Welcome back, Fail Safe Wealth family. Welcome to my page, Fail Safe Wealth. If this is your first time to my page, hit that subscribe button and become a member of the Fail Safe Nation, where we do fail safe investing, where we do our homework, look into these companies before we invest into anything, and pretty much do it as a family. So I have another special edition of Battle of the Brands, where I take two companies, put them up against each other at the end of the week and ask myself 3 questions. Which one will come out on top on growth, sustainability, and value? And in today's edition to Battle of the Brands, this is an actual Battle of the Brands. So if you've seen my last video that I did on Battle of the Brands, it was on a company called Tapestry, and Tapestry owns Coach, Kate Spade, and Stuart Wiseman, where I did a little homework. I went out, I found a company that truly competes against Tapestry, and you probably don't know this company, but you definitely know the brand. So like I said, hit the subscribe button if you haven't subscribed to my channel. If you like the video, by the end of this video, hit the like button, but stay tuned and let's do it. Let's go. Okay, so the name of this company is VF Corporation. So VF Corp for short, ticker symbol VFC. It's selling around like $63 a share today. They have about 68 cents in earnings per share. Like, that's 68 cents. So that means that their price to earnings is about 93. Their price to earnings ratio is 93. That is crazy high for almost any stock that you're going to invest in. But for growth stock, that is not high. But this isn't a growth stock. This company been around since 1899, so that's over 100 years. They are a huge apparel company. They have a dividend. Their dividend yield is around 3%, or close to like $2 a share right now. Now, I will say that this company was selling around close to $100 before the big dive in March, where a lot of companies pretty much went down, or the huge sell-off, you could say. Let's just say prior to the pandemic. So yes, this company was selling around $100. So it's down about 40% or 30%, somewhere around there. Now, if you look at the chart of this company, the trajectory was going in a good direction. There wasn't too many big dips. This company was definitely going up. It has a lot of hype behind it, so that is good, I will say that. And the number one thing that this company has going forward is brand recognition. I have to say it, like, you know these brands personally, you own some of these products, you've seen some of these products, you probably want some of these products and can't afford some of these products, but you know VF Corporation products. So to say the least, I don't know, I didn't memorize like all the products, but they have Timberland, they have North Face, they have Vans, they have Esport, they have Dickies, they have JanSport. They manufacture denim for other companies. They have a lot of companies, like a lot of companies. And all of these brands are big name brands that pretty much are great brands no matter where you go in the world. Like North Face is everywhere. Oh, and they also have a brand called Napa Pedri. And Napa Pedri, I think I'm saying that correctly, is a brand that is really big in Italy. Like if you go to Italy, you'll see a lot of people wearing Napa Pedri. I own a Napa Pedri jacket. Great material. It's pretty nice, I'm not gonna lie. But yeah, they have some really, really great brands. Now, usually when I do a stock analysis, I like to list the risk factors of investing in the company. Now, I know you're probably saying, depending on what you can afford, $60 might be a lot to you, $60 might be right within your price range. But based on the metrics that we use to value a company, like the price to earnings ratio, the price to earnings growth ratio, and things like that, this company would be considered overvalued to a lot of analysts. But it's all depending on what's your criteria. Like, what do you use to value a company? And you can't really just use your own personal pocketbook. You can't say, I only have $1,000 to invest, so I'm only gonna look at penny stocks because I wanna turn this 1,000 to 100,000. You kind of gotta be realistic. And I'm gonna be honest with you, long-term investing is always the way to go. So you definitely should understand stocks and how to value stocks and use valuations and metrics to value stocks, like the price to earnings, growth stocks, value stocks. You're not gonna look at those the same. And so, like I said, this company does have some very high valuations, and the market cap is around 24 billion, so it's pretty solid. And this company is old, have solid brands. So I will say the risk factor is there, even though this company is very old. They've been around for a long time. They have some A1 brands, but you have to remember these like apparel companies spend a lot of money to manufacture these products, and a lot of their products has to be flown in from China. Let's be honest. So a lot of their products are made in China. So if China and America is having a trade war, that is a risk factor. Now, I'm not going to say that it's going to get to the point where they're not going to be able to fly their products in, because 9 times out of 10, the little trade war is about tariffs, and so pretty much they're just taxing imports and exports from China. So like if you go in a North Face store, which is already expensive to my standards, I do own North Face, but I'm just going to say like North Face is kind of expensive. They're pretty much just going to go up a little bit in the price of the product to compensate for that tariff or that tax on that product for the import or export. So as an investor, I will say VF Corp is a solid investment for the long term, but this is something that you would have to look into personally, and you would have to believe in this company yourself, meaning like you would have to believe in this company. Like I mentioned in the Tapestry stock analysis, I do own Tapestry, and I do believe that Tapestry can probably triple my money or maybe even 5 times my money. But if you look at Tapestry's chart, Tapestry has taken some dips along the way, and that's not really good, but the evaluation for Tapestry is very attractive right now. Like the revenue that they bring in versus the market cap that they have, the price to earnings ratio. They did pay a dividend when they was paying a dividend. This was a solid dividend paying company. So that's what made me go with Tapestry. It wasn't the price, because some stocks that I'm buying right now are like $50 a share, and I own more of those shares than I do Tapestry. So it's not about the price, it's about, am I getting a deal for this stock? Because you have great companies that make bad investments just because the stock price for the share is overpriced based on the whole entire company. And I heard an analogy today that I'm going to tell you. I didn't get the name of the guy who said the analogy, but it was a great analogy. And he said, when you're looking at a company, you kind of got to think about it like this. If I'm selling you a car and I say this is a brand new Mercedes-Benz this year, has everything you want, everything new, right? Really great car. You know that the Mercedes-Benz is a good car. But if I say I want $20 million for that car, you're gonna say, what, 20 million, I'm crazy, right? Because that's overpriced. So that's how you kind of gotta look at a stock. Like you can see, you can have a good company, but it might be overpriced, or you can look at the price and think that it's overpriced and really it's cheap. Like you have some companies that are cheap. I did a stock analysis of Tesla and I said, even at 1,500, I didn't think it was overpriced. I thought it was probably fairly valued, but I definitely didn't think it was overpriced. And a lot of people say it is overpriced. Now Tesla's doing a 5-for-1 stock split, and it didn't have anything to do with the evaluation of the company. It was just to pretty much bring in more investors, make the stock a little bit cheaper, more attractive, sort of say. But VF Corp, in my opinion, I don't think it's a bad investment. It's in the consumer discretionary spending sector. So let's say you already have a tech stock, you already have a consumer staple stock, or you already have a financial stock. This would be a really great stock to get into the consumer discretionary sector. So if you were looking to get into that sector, apparel companies don't really bring in that much revenue to begin with. Like I think Tapestry bringing around 4 billion, or no, Tapestry bring in around 6 billion. So Tapestry bringing around 6 billion, and VF Corp bringing 12 billion. So these companies really don't bring in that much revenue, but they're still good investment. They still pay a dividend. Now, we'll mention this about VF Corp's dividend. The dividend payout is north of 200%. So they're spending double of what they're bringing in to pay out a dividend, and that's not good for any company. I've done videos on like dividend stocks and the scary truth behind them, and how some companies overpay just to pay out for their dividend. Like they're spending way more money than they're bringing in just to pay out a dividend. And I definitely recommend you go watch that video. But VF Corp, with the brands that they have, like I said, they could probably leverage their brands, and they've been around long enough to have that type of credibility where they could probably issue more bonds. They can pretty much raise money, let's just say that. They could probably sell off some of their brands. They can pretty much maneuver. They're big enough to maneuver also. So they have a future. Now, if that future is profitable, it's gonna depend on a couple factors. Like I said, if you look at the chart of this stock, it's not too many dips. It's pretty much trending upward. And so, yeah, I mean, if you buy it now at 60 bucks, and if you buy enough shares, you can get a pretty solid return, because I can see this company going back up to $100 per share in normal times where people have discretionary spending, you know, or dispensable money. So it's a couple factors you got to factor in, and it's all to your discretion. So that's just my thoughts on the company, but you know, I can't end a video like that. We have to go into the financial statements and see if this company is financially stable enough to weather the storm. So let's go. Okay, so starting off with VF Corp's balance sheet. Like I've mentioned in this video, I said they brought in 12 billion. Well, they actually brought in $10 billion in revenue in 2019, which is actually down 2 billion from the 12 billion that they brought in 2015. So they've actually been losing revenue over the last 5 years. I'm just gonna put that there as a side note. But so $10 billion in revenue, they had $1.3 billion in cash on hand in 2019, and they had about $5 billion in current assets, which means that they could liquidate today or tomorrow if they had to within the next 24 hours, versus $3 billion in current liabilities. So that's current debt and liabilities due within the next 12 months. Now, that's a little close for me, a little close for comfort when it comes to like debt versus assets, but it's not bad. I've seen worse, believe me. So when we look at the total assets versus the total liabilities, meaning all of their assets totaled up versus all of their debt liabilities for within 12 months and beyond 12 months, we're looking at 11 billion in total assets versus 7 billion in total debt and liabilities. Now, like again, that's a little close for comfort, but it's not bad, it's not terrible. Now, when we look at the income statement, $10 billion in revenue, and it was left with about a little over $600 million in net profit. Now, that is good, especially for an apparel company. Like I said, these apparel companies aren't like cash heavy. They're not bringing in a lot of money in revenue because, you know, it costs money to make their product and import their product and all of that. But 600 million in profit is good. That's really good for any company, to be honest. Any company, that's pretty good. It's not Apple's like billions of dollars in profit, but it's a profit. All right. So moving on to the cash flow statement, they had $629 in net profit. When you subtract $288 million in capital expenditures, you're left with about $341 million in free cash flow, meaning money that they can do whatever they want with. And when you pay a dividend, it's no wonder why their payout ratio is so ridiculously high at 282% payout ratio, because you're not bringing in that much free cash flow to pay out a 3% dividend yield. You could just lower the dividend yield. There is no law that says you have to pay a dividend, but I don't want to go on a rant. I don't want to go crazy. Like I said, it's not a bad company. How it's being managed, I wouldn't agree with. I personally wouldn't invest in this company, and it's probably because of the management, because some of these evaluations, I'm not gonna say they don't make sense, but they're not attractive to me. They're not making me say, yes, I can see the return on my investment, especially with a price to earnings ratio of 93. That is just ridiculous. Even though Amazon had a price to earnings ratio of like 1,000 at one point, which was crazy ridiculous. And that was when the stock was selling for around like $1,000 per share. And now Amazon is selling for $3,000 a share, but they have a huge e-commerce market share. And you know what? That's a video for another time. But I want to know your opinion on VF Corp. If you knew about VF Corp before the making of this video. Thanks for watching the video. If you liked the video, hit the thumbs up. If you haven't subscribed to my channel, this might be that reason or that time to subscribe. I don't know, you know. A lot of more fail-safe videos coming soon. I'm gonna do a video soon on how to evaluate a company in a recession, because we technically are still in a recession, and these valuations aren't like normal valuation times. A lot of earnings per share is going to be off, and since the earnings per share is off, the price to earnings is going to look crazy ridiculous, like with VF Corp and other things like that, and other metrics and valuations. So that doesn't mean stop investing. That just means educate yourself, and let me know what you think about the video. So till the next one, let's get it, let's do it.